Welcome back to another Stack Market Open Live. Today we have Lego Man. This is one of the gifts that Jack gave me for Christmas. I love Lego Man. Anyway, so welcome aboard. Today, some of the things to start with are we've got half of the Red Sea shipping container fleet is still rerouting not through basically the Red Sea. So you've got half that regularly transits through the Red Sea is still going through the Red Sea right now. And that's Flexport, which counted usually about 299 vessels that would be going through the Red Sea that aren't. Now, that is up double from a week ago. So we've kind of like halved, and now we're coming up again. The trips around Africa do take about 25% longer. Last week when we were at the worst of this, we saw container prices up substantially from $2,400 for a 40 to up to $10,000. We saw air freights go up. We saw trucking rates in the Middle East go up. There was actually a lot of very quick impact. The big question is, how long does stuff like that last? And so obviously we're on the way back to calm, and hopefully that continues. Although as soon as it was within a day of the United States essentially arriving with a larger presence in the area and resuming shipments with Maersk, that we had another attempted attack. Although fortunately, so far it's been, knock on wood, it stays this way, a little more quiet, because that's one of the big things that we want to avoid is any kind of inflationary impacts. Let's enjoy the disinflation that's occurring. We like that, mostly because, I mean, let's be real. I don't think anybody would want to cheer for more inflation at this point. I think we've had enough of that. So anyway, that's a little heads up there on Red Sea. Not back to normal, but trending in the direction of going back to normalcy. So then we've got, let's see here. I thought it's very interesting. I think Nick T's like off. You basically have like no economic tweets from him in almost a week now. Like it's time for like a welfare check on Nick T here. I miss looking at my Nicky leaks. No leaks, I guess, during Christmas. Anyway. A lot of talk about what's to come for 2024. I've been reading some institutional pieces on this as well. Really, I mean, we've talked about this before as well. The biggest concern that people have is, well, if there's not going to be a recession, then what about earnings? I mean, that's typically just what people seem to be most concerned about now. Oh, and it's interesting because we are going into earnings here in January. So it's so weird to think that it's January already almost. It's kind of wild. December 28th today. Anyway, then we've got some of these headlines, frankly, I will say, are scary. Global Bond Carnival sets stage for best 2 months ever on bonds. NASDAQ, best year since 1999. And then you have other headlines like investors get rich off trade. Like, wow, there's a lot in terms of sort of making you feel like, are we due for a correction yet? But I'll tell you, one of the things that I remember seeing in just these other crises is that it's so difficult sometimes to try to time, like, okay, well, when do you want to start taking some profits? Because sometimes it just keeps going. It's crazy. Okay, well, let's quickly hit the numbers here. Jobless claims just came in, 218,000. The expectation was actually 210. So about 8,000 more jobless claims than expected. Continuing claims come in as expected. A little bit more on jobless claims. reminds the Federal Reserve that we do have a dual mandate. He's always pretty animated. Let's listen to his animations here.
Of last year. Now, on initial jobless claims, expecting 210 to 212,000, 218,000. That would be the highest since the first week in December, where we were at 221,000. And if we look at continuing claims, which the last time we were at 1.9 million or higher was the second week in November. It's slid ever since. Continues to hover under 1.9 million, 1,875,000. Pretty much spot on with estimates, and subtle revision in the rearview mirror puts this one a bit higher, as rearview mirror is now 1,861,000. So, as I said, haven't been above 1.9 million since November, and when we were, that was a 2-year high. So that is a significant level we remain below. And finally, let's look at trade balance, which of course is a deficit. And this is for the month of November, minus 90.3 billion. That is the biggest deficit going back to July of this year, when it was just shy of minus 91 billion. We see that interest rates have moved a smidge lower on this data, and most likely it's the continued how well behaved claims remain, even though initial were slightly higher. And we see that pre-opening equities have shaved their losses just a bit, with Dow futures down 30 as we get ready to go into the big New York opening. What I want to stress here is 380 right now on a 10. It closed last year at 388. Now, contrast that with the yield curve movement. A 2-year last year closed at 443, Mike. It's now hovering at 425. And if 2-year notes closed
less inversion
right now, they'd be at a fresh 7-month low yield close. 10s will be at a 5-month fresh low yield close. And boons, well, boons will be at a 1-year low yield close, as Europe has a much different view of an economy for 2024, much slower. Mike, back to you.
For sure, Rick. Yes, global bond rally maybe.
I love listening to him. He's always got that. He's got to slide in the slightly negative perspectives. Like, oh, it's because the yield curve is representing that the market's going to be slower next year. Okay, all right. Yeah, I mean, look, relatively stable here on continuing claims. They can be quite volatile. Within 8,000 here. I mean, last week we had a miss of about 10,000 or so. Now we're up about 8,000. It all seems to average out. I like to look at it sort of graphically and just kind of see. So I'm going to go ahead and pull that up so we can take a peek at that and see what the initial jobless claims look like over time. The problem is when you look at some of these charts, you have to remove COVID, because everybody seems to have gone jobless at that moment. And you just get these bizarre charts. But I'll go to about mid 2021. Probably gives us a little bit of more of a long run average. So otherwise, I probably have to go all the way to more like late 2021 to kind of get like a little bit more of an average. Otherwise, you're still just coming off of COVID, and the numbers are wild. But this could give us an average over at least the last 2 years, and you can see how volatile this is. We actually had a lot more claims for unemployment this summer than we did or have recently. Consider this. Here it is. Look how volatile this is, first of all. And throughout 2022, we're actually reducing claims here for quite a while. This was right around the time of Jackson Hole, where Jerome Powell was pretty pissed there in September of 22. And it makes sense, because look at how low those unemployment claims had gotten. It wasn't actually until this summer that you start seeing unemployment claims rise quite a bit. And then if you took sort of an average here, I would venture to say it's somewhere around this 215 level. Just trying to average some of the heat over here and the softness here. But also interesting, because it somewhat aligns with Powell. Powell gets very aggressive over here because he can, and he gets more dovish in this area. So, or I guess on this half. Very interesting. Okay, So let's listen in here, see if there's any other extra commentary on this, although this seems relatively benign.
I mean, at this point, there's a lot of room in there while we can wait to see if things improve in the right direction, which, of course, is why the market has kind of fast-forwarded to looking for rate cuts.
Yeah, I just think that people get ahead of themselves on the timing. There's been an enormous amount of progress on inflation, no question about it. But remember, everything broke our way in 2023. We got a productivity bump that no one saw coming, 2.3%. We had declining energy prices, 6% year over year. We saw some moderation in food inflation. And so everything that could go right did. That's not going to happen every year. So I think being cautious about where we land in 2024 is the right stance right now.
And Bharat, I mean, clearly there's dissatisfaction out there with a few things in terms of how the economy is operating. You can't complain about sub 4% unemployment, obviously, but housing affordability is something that hovers over a lot of people. We have this sort of locked up home market at this point with very little turnover. And then, of course, the absolute level of prices is relatively high, and people still kind of anchored to that. So is there any way that things can happen in the coming year that can alter those things?
Yeah, when I look at this, I really look at the three core things that families spent most of their money on: housing, food, and gas. If you look at housing, actually, it's important to make a distinction between the rental market and the home ownership market. In many metro areas, rental prices have been pretty flat or actually declining over the last year. Of course, with interest rates going up, housing affordability, home ownership affordability is a problem. And so I think that's something that the administration should try to address. On grocery prices, they've actually been flat to declining over the last year. So while they went up substantially in the initial stages of the pandemic, in part because of Russia's invasion of the Ukraine and what that did to commodity prices, we've actually seen a lot of steadiness there over the last year. And of course, on gas prices, we're back down under $3 a gallon nationally. So.
I don't know. Yesterday I made a video on this covering just what we talked about briefly on HouseHack, was this idea that you have two different types of consumers, and I think when I hear about the consumer like this on CNBC, they just want to talk about gas prices. But I'm looking at the nuance personally of which cohort of the consumer do I think does better, going forward. And again, you can see this over on ehack.com. But for me, I think it's going to be interesting to start looking at home improvement, obviously solar and the autos, which are interest rate sensitive, but also furniture, RVs, pets. Thinking about people refinancing it or taking home equity lines of credit out of their homes, which makes people wonder, when does a rocket mortgage bottom? These are some interesting things to me that could see some nice movement, as opposed to your classic staples like Costco, Walmart, Target. Technically, it's considered discretionary, that one, but those or gas prices or whatever else. So I don't know. Maybe that's just most relatable to more people or something. Who knows? Okay, so then we've got, let's take a look at catalysts going forward in terms of other data to look forward to. I think really the next big, we've got January 3rd. We have ISM prices paid along with the manufacturing data, and we also have the JOLTS report. So mark your calendar for Jan 3. Jan 3, again, that's going to be JOLTS, ISM prices paid. Those will be interesting, but we'll also get the meeting notes, Fed FOMC minutes. Now that will be a very interesting one because it'll really set us up for seeing or taking a glance at the commentary around rate cuts. Remember, Jerome Powell made this pretty clear. There weren't technically discussions about rate cuts. You kind of go into the meeting and you start giving, you have the option to give your own forecast. Hey, I think, we'll probably start talking about rate cuts in February, January, February to set up for March, and we'll have 3 rate cuts next year. The reason I think that is this, and this is what we're seeing in our district. So you have a meeting like that, and that doesn't necessarily mean it's a discussion, but it has come up, right? That's something that's been a little confusing for folks. So I wanted to add clarity to that. So all of that is on January 3rd. Well, that's Wednesday, I'm pretty sure. Oh, look here. January 2024 calendar. Yes, that is Wednesday. Following that, we should get our jobs report. Where's Friday? Let's see here. Yep. ADP on Thursday the 4th, looking at 113,000 jobs. And let's go out a little more. Then we've got payrolls, looking for payrolls on the 5th of 170,000. Pretty much average. Last was 199. And then we're looking at CPI. We actually don't have a core month over month. Do we? Oh, no, we do. Yeah, here. Looking at 0.2. 0.2 on CPI month over month and year over year. And that's aiming for the 11th. So 3, 4, 5, and 11. Those will be some catalysts to look forward to. Oh, thank you for pointing out that my title is actually yesterday's date. That's funny. Who would mess that up? Me. Oh, well. Thank you for that. I'll get that fixed. Okay, good. So now let's take a peek at what some of the suits are saying. We have, let's see, jobless. Yeah, there you go. Joblessness data. And see, and I knew it. It was like a tiny little fluctuation. But then you're gonna get comments like this. Jobless data confirms dovish rate outlook. I barely came in a little higher, but it's okay. Remember, Fed's now a little more focused on that dual mandate, which is a good thing. So, what do we have here? They say, I'll change that date really quick. There we go, 28. Boom. Okay. Continuing jobless claims are holding steadily at a relatively high level, enough to justify recent dovishness, but not enough to shift the dial for assets, especially at this late stage of the year. Initial jobless claims came in higher than expected, barely, like 8,000. But how are things actually moving after the data? So if I look at, bonds still up 2 basis points today. Not only are bonds up 2 basis points, but looks like in terms of market reaction, let's look. We'll do it together. We'll do it live. All right, here we go. There was when the data came out right here, a little volatility, but we're up from then. Tesla's up 1%, Airbnb's up 30 basis points. You've got Nvidia up at 497. Interesting. Remember Tesla yesterday? We actually got the close. We got the close above 258. That's a potentially pretty big moment as a trader, in my opinion. Look at that. I mean, this is your day chart right here, but you're breaking a trend on the week chart right here. It'd be nice to get now the next confirmation that you really need would be a full candlestick above, right? Not this little peaky doodla. Now you got to really clear it to break it. But having a close above it is certainly a step in the right direction. All right, let's see what's making big moves here in the morning. Actually, yeah, Tesla, Neo, some of the bigger ones. Redfin, ARM, Bill.com. Look at that. Bill's back to 84. They were so interesting. They ran up to 130 and then to 60, and now they're at 80. Boy, the volatility on that one's been crazy. Coinbase down a couple percent. Daily fluctuations. I mean, the thing was up 7% yesterday. How could you be mad? Look at this chart. I mean, it's insane. It's just straight up. You look at the week chart. The only way you could make yourself feel better if you don't own it is by looking at the week chart. But that's all right. All right. What are they yapping about?
Let you stretch it out or BNPL.
You know you can now do.
Affirm.
You're going to be able to do buy now, pay later at Walmart checkouts.
Yeah, well, you've always kind of been able to do this, right? You could just pay with the, with a card and then turn it into buy now, pay later. But this would make it a little more frictionless, I suppose. They seem to be targeting the right audience for it, I suspect.
I think.
I'm not sure.
Right? Like you
lay
pay,
away until you actually pay.
Yeah, they would say, you want this, we'll put it aside. When you make your final payment, you get it. We're kind of inverting that.
Well, it's just interesting.
I could say it's dangerous is my point a little bit.
Well, as we talk about just how consumers are spending and the overall debt levels and rising delinquencies, I mean, the overall makeup of how they're using their wallet is different.
Yeah.
And I think it's it's interesting in the environment. As 2023 draws to a close, the Magnificent Seven of mega cap tech stocks have captivated investors, and the promise of AI technology is fueling optimism about the industry in the coming year. Joining us now is Glenn Kacher, Light Street Capital founder and CEO. Glenn, thank you. Happy New Year.
Who has a California flag?
Maybe we can just start with your playbook for 2024 to get a sense of where your head is at with regard to the recent run-up in AI names, those that are adjacent to AI, and then how you're thinking about things, how you're constructing your portfolio going into 2024.
Sure thing. So, I think that when we look at AI and the opportunity there, this is a multi-decade opportunity. And so, as much as there will be ups and downs over those decades, we look at this as being a huge tailwind and opportunity that compares to the shift from PCs to networked or client server software, and as well the move to...
Okay, this is like mega boring. All right, so let's see what else we have here. So the other suits, Brazil just sent a warning to U.S. investors. Both equity and bond traders in U.S. and other developed markets are expecting relatively smooth downward path for rates. But Brazil's inflation for early December came in far faster than economists had expected. 40 basis point monthly increase was largely driven by transport costs, blah, blah, blah. Okay. Yeah, that's going to be the interesting thing is, and it's one of the reasons I'm not, as tempting as it is to be short the dollar right now, which you could do through an ETF like UDN, as tempting, so in other words, the dollar goes down, the more this goes up. As tempting as it is to short the dollar, the problem you have with shorting the dollar is if everybody else goes into a recession, the U.S. is still the best of the worst. If, we dodge a recession and as our rates come down, usually the dollar weakens as rates come down because then you go looking for, other assets, currency-based assets that could strengthen. Obviously, you want to own a currency that goes up. I mean, who doesn't want to own an asset that goes up? All right, so now let's try the Doom Burgers. And as well as, let's see, what else here? How hedge fund hindsight had another magnificent year. This year is almost over, and it's time once again to return to the offices of Hindsight. Hindsight Capital. That's literally the name of the fund. I never heard about that. Okay. And this has to do with Brazil. Okay, all right. I thought that was going to be interesting. It really wasn't. All right, let's listen in here.
I think the answer is clear. Nobody ever lost money betting against Arab-Israeli peace or Middle East stability. And I think wherever you look, there's a headache. The Israeli-Lebanese border, potential of escalation in regional war, not predicting it, but it's got to be watched carefully. The Houthis, 33 attacks, 100 drone and missile strikes since October 7. A problem right now without a good solution. The Israeli-Hamas standoff, mutually irreconcilable goals. Hamas wants to survive. The Israelis want to destroy it. People of Gaza, 2.3 million, half of whom are under the age of 15 to 18, are suffering. As a consequence, and the Israelis, of course, have been traumatized by the Hamas October 7 terror surge. So no, I look around as the 2023 comes to a close. I guess my prediction for 2024 is it's going to get worse before it gets much worse.
How does it get worse, Aaron? A very good morning to you. Blinken goes to the Middle East over the next...
Yes, please, bear argument. I want to hear it.
Multiple trips have now been made. But first of all, characterize for us how this gets worse. Is it directly in the Hamas-Israel conflict itself, more deaths? Or is it an escalation via proxy?
I mean, I think the real concern, if you want to strip it down to its essence, the U.S. has three, I would describe them as vital interests in the Middle East. The must-haves, as opposed to the discretionary interests, which are it would be nice to have. Number one, prevent a terrorist attack on the continental United States or its assets throughout the Middle East. Number two, maintain access to Arab hydrocarbons. And number three, prevent the emergence of a regional hegemon, in this case Iran, with the possibility of a nuclear weapon.
Yeah, that's exactly why. we've got as many ships going to the Red Sea as possible, just to make sure Iran is nice and in its little box. Now, what is fascinating is that there were some rumors. I think it was Saturday on the 23rd in the morning that Iran was backing the Houthis with intelligence, and maybe that is happening. That's not what I'm skeptical about, or what's interesting. But there was a lot of talk about Iran really helping the Houthis and how aggressive Iran wanted to get involved in the region, and they came out like 3 hours later after all these stories were running on Iran being so aggressive. And they're like, no, we don't want any conflict in the region. We're not helping. We're not trying to cause conflict. And I thought it was so interesting how quickly they came out and like, no. Because you could easily come out and be like, yeah, the U.S. needs to get the hell out of here or whatever. Didn't get any of that. I don't know. I think more and more, hopefully, countries start realizing, especially developing ones, or those that have more, or those that have ambitions that maybe don't necessarily align with the United States, start realizing, hey, there's a limit to how far you can get by being ridiculously aggressive in a tinderbox. I wonder how much of an economic benefit Putin's really getting out of his incursion into Ukraine, for example. Certainly, by most measures today, we would look at Putin's actions as having devastated parts of Russia's economy, if not more. Anyway, the Financial Times has this headline article on China, and it indicates foreign investors unwind $33 billion bet on China. Every time I see numbers like that, I always just compare it to like Elon Musk selling $24 billion in 1 year, and it just goes to show you the magnitude of how much he had to sell Tesla stock to buy Twitter. But it suggests here, the Financial Times suggests nearly 9/10 of the foreign money that flowed into China's stock market in 2023 has already left, spurred by mounting doubts about Beijing's willingness to take serious action to boost flagging growth. We peaked in August, I guess, here, and net foreign investments in China listed shares this year have dropped 87%. I mean, one day China will definitely boom again, I expect. But boy, very interesting to see what we might end up getting. When's China gonna bottom out? Who knows? I think so much has to do with China's housing sector, and we have the opposite problem in the United States. We've got too little housing, and too little housing driving up homeowner net worths, whereas in China, you still have sellers of real estate, quote, cutting prices aggressively. Interviews with more than 24 real estate brokers across the capital, along one of China's most desirable real estate markets, Beijing, showed transaction prices have fallen between 10 to 30% from their peak in 21, and we still haven't recovered from those sorts of drops. In fact, home prices dipped 1.4% in November year over year, up about 5% from 2 years ago. So you see that volatility, but a lot of that sort of COVID enthusiasm in real estate across the entire world has relaxed substantially in China. Again, overbuilding in China, debt crisis, government encouraging the taking on of substantially more debt than developers should, only to turn around and sort of rug pull those developers with changes in policies via the 3 red lines. Anyway, very interesting. The moves in China. The one thing you could do is you could look at like the MSCI China if you wanted to, and you've got a bunch of different indices you could look at for that. Clean tech, just as an example. Here's what clean tech looks like, the MSCI China clean tech. Honestly, probably doesn't look too terribly different from a lot of clean tech in America. Energy, clean tech. But you get a bunch of different countries over here. And We'll type in China here a little bit more. Let's look at their real estate sector. Now, straight down on the MSCI China. MSCI China. How about the consumer staples? Yeah, everything's just down. And we're going back to levels of 2019, basically. And the question is, when does it end? When do you buy the dip in China? You've got Kenny G. He's buying the dip in China. Here's IT. Really interesting. No. All right. Good. So now let's see here. There is, yeah, I've seen a few people now mention this Wall Street Journal misery index piece, and the article talks about how can spending be up when people are feeling down, and it suggests, according to the misery index, Americans shouldn't be all that miserable, but they might only recently have started to catch on. The misery index is a simple summing of the unemployment rate and the inflation rate. Okay, just add those together. So in other words, like if you had 10% unemployment and 5% inflation, you'd be at 15%. Well, we're at what, 3.5 for unemployment? No, we're probably like 3.7, eh? Okay, here, yeah, we're at 3.7 right now. Add 3% inflation, 6.7. So, okay, are they trying to suggest, yeah, you shouldn't be that miserable? What are we at here? Yeah. We're at 6.8 versus 12.5 in June of 22. Yeah, well, that's when inflation was like 9%, and then you add 3% on that. Okay, interesting. I wonder how long this like leads consumer sentiment. Like if you overlay consumer sentiment on this, how long does it actually take? That could be interesting. We could probably figure that out. Let's do like a misery index. Measuring misery, the Fed blog. Yeah. Okay. Yeah, so here's the misery index. And I don't have tools to overlay over this right now, but I think it would be so interesting to see if this is the misery index, which is basically suggesting a lower level here. And here are some of your peaks, you know, COVID, unemployment mostly from COVID. And then the summer over here in terms of misery. We're sitting at levels like what we saw in, 1999, late 90s. You've got briefly here, 86, 72, and then you have even less misery over here in the 60s. Oh, interesting. Oh, they have the chart in there. Oh, thanks, Max. That's what I was looking for. Oh, you're right. I already have a screenshot of that. I misread the label. I saw happiness index, which is them inverting the misery index, which I thought was really funny. Yeah, so they've overlaid the two. Let's see if we could find the lag between it. Okay, here it is. Look at this. So, not really. They actually seem to operate. So they flipped the misery index on its head to create a happiness index. That sounds nice. And you almost have a perfect correlation here, it seems. They're almost perfectly correlated. You know, minus some of the extreme spikes that don't necessarily show up. So, but look at the gap. I think if you look at the sort of gap and trend between the two right now, consumer sentiment really, yes, it's rebounding, but it hasn't rebounded as much as, you know, the misery index has fallen, or the happiness index, I suppose, has risen. It's fascinating. It's interesting chart. I wonder, a lot of folks suggest that this might be because of politics, that people have a desire to essentially bag on consumer sentiment surveys because they hate Biden so much. That's just what some people talk about. I don't know. It could be nonsense. I mean, how do you even measure that? With another survey?
Supply, but I also don't think it's going to be very.
I'm sorry to.
Oh, yeah, they're transitioning to the 6 a.m. over here. Okay, so yeah, looking at oil, we've got oil right now. Oh, well, okay, back down. Well, that's nice to see because we had a little spiky doodla there in oil prices. Now we're down to 78.53, down off of the 81 we ran to just a day or two ago, and then you're still pretty low on the average for the year. You're still near lows on oil prices, and you could really go back to the Q3 2021 where we are with oil prices. It'd be nice to get back to about the low 70s in Brent, so you kind of get to the pre-COVID. So let's see what Sarah says today.
3% away from a record closing high. We'll see if we can get there today. Our roadmap begins with that record watch. S&P inching closer to all-time highs as the Santa Claus rally rolls on, with the Dow and the Nasdaq 100 hitting their own records. Plus, Tesla shares at a 3-month high and seeing the third best year on record. But will waning EV demand prove a headwind for growth in 2024? And why one analyst thinks AI will become Microsoft's iPhone moment in the next few years.
Yeah, I think what the most important thing for Tesla and earnings coming up here is the forecast. How has there been an inflection in sales up? That's all we need to hear Elon talk about is, are things getting better or are things getting worse? That would be very interesting.
The important thing here is 47.93. That would be the closing high of January 4th, 2022. We're very close to it, within fractions of a percent. That's the remarkable move for the year that we see. I think this time last year, remember, we were preparing for a recession. Everyone was expecting it. Everyone was expecting an earnings recession. There were people who had 200 on the S&P 500 for the earnings estimates. We're going to end the year close to 220. We have $245 on the S&P for 2024. So the consensus was completely wrong. And I think two things happened that were quite amazing. One was the Magnificent Seven stepped in. The AI became the predominant paradigm, the biggest paradigm since the internet, essentially. And number two, the recession never came. The recession never came because the Federal Reserve essentially reduced inflation without dramatically slowing the economy. I think that is a remarkable story. It's extremely rare. You and I both know, Sarah, soft landings are very rare animals. And that is the main story of 2023, in my opinion, the fact that we did not have the recession. Now, who knows if we'll have one in 2020.
Oh, it's coming next year. It's always what they say next.
Based on a lot of forecasts in 2023, in December 2022, you would have been making a lot of big mistakes. Essentially, staying with the market was the smart thing to do.
And I think in the last few weeks, as it relates to this latest rally, which just got supercharged by the AI rally of 2023 and the lack of recession, really, I think the surprise is how fast inflation has come down. The disinflation story that has allowed Fed Chair Powell to pivot and has allowed the 10-year yield to rally. I was just looking at the low since
10-year bonds to rally, yields to fall. Anyway, the next Fed meeting, is it for another 5 weeks? Technically 4 weeks and 6 days. But we don't get J-Pow for a while. I'm a little disappointed here. I'm just looking at the rate futures here to see what we're pricing in for December of 2024. We're looking at, oh my gosh, wow. Yeah, add this up over here. These are some crazy numbers here. So we're looking at 9.9, 37.8, 35.3, 97.2% chance that we are we're at 4. That would be 5 rate cuts. 5 rate cuts have a 97.2% chance. And 6 rate cuts have an 83% chance. And still still a coin toss would actually be 7 rate cuts by the end of the year. Wow. Starting to price in 7 cuts.
We're going to get a lot of rate cuts. And there's your first pain trade right there. Fewer rate cuts than expected happen in 24 that disrupt the markets.
Like
that's the concern.
Yeah, I think 150. Six rate cuts starting in March. That's a lot. And if for whatever reason we get the economy unusually strong or inflation doesn't go down enough, the Fed doesn't cut in the order and sequence expected, that's going to be a hiccup. The second is that we get a bigger slowdown than people anticipated. And by the way, both of these things could happen. You could have the Fed's keeping rates high if inflation's high. Economy still slows down, but the Fed doesn't go ahead and cut rates. That's a worst case scenario, but that could happen. So there's your second pain trade. Finally, the earnings slowdown. I am not particularly impressed with what I see early on with the early reporters for the fourth quarter. The revenues are generally below expectations. We've had a lot of disappointing revenue reports. We see a little bit of disinflation, a little demand reduction going on, and that could be, revenues could be a story for 2024. If the economy softens significantly, we get disinflation, companies can't raise prices the way they did in 2023, revenues could be a big issue. So there's your three.
I don't know how much. I know there's so much talk about this, recessionary numbers and stocks and weak earnings. I honestly don't know how much that matters as your baseline trade. I think what matters more is convincing people that inflation is gone. Once you do that, the baseline, I think, is up. And clearly that started to happen over the last year. It's been a volatile Nike swoosh so far. Now, knock on wood, that could continue. But I don't know that, misses here or there, which obviously will lead to fluctuations and stock swings of 20% in either direction. I think that's just normal in sort of these volatile times. I don't know that it matters as much that rates come down perfectly or quickly. It's like, oh, well, like for example, does it make sense to sell stocks because you think, well, I think the Fed's only going to cut 3 times and the market's pricing in 6. We're in for a big correction here. Not really. I'm not convinced of that. I'd be much more, interested in ultimately what happens with earnings. But beyond that, that's more interesting to me than how many rate cuts we get. So if I put these in order, it's like, okay, yeah, it's aggregate earnings, rate cuts, but the very most important out of everything is what's inflation doing. As long as inflation comes down, you could really do whatever you want with rates, and eventually they will.
In 2023.
Nobody thought we would have a regional bank crisis either, where we had a few failures.
That's right.
Including SVB, and managed to come out of it with financial stocks as the top pick for 2024. I mean, the regional banks did underperform this year, and I think a question mark for that group is commercial real estate exposure, and if that starts to...
Yeah, well, and look at, and she's not wrong. You started seeing some more funding into the bank term funding program last week as we saw about an $8 billion rise in the Fed bailout program for banks last week. But look at this. This is JPM here. JPM at 169. It's higher than it was pre-COVID. It's higher than it was in 2021. And yeah, it had a little correction doodla here in mid-22. But boy, the banks have not been a terrible play. Well, at least JP Morgan, at least.
We actually expect momentum to be picking up. And, if you look at the Goldman Sachs economic forecast, they expect consumer spending to be better. They expect growth to come in better at 2%. That's not what people were expecting at this stage of a Fed tightening cycle.
And yet, why can't we get consumer sentiment higher? The market is telling.
There it is. There's that misery index.
In good shape. And yet the investing public doesn't seem to be believing in it. It's remarkable to me. There's a disconnect between the markets and what the general public seems to be believing, right?
I don't know why he thinks that's remarkable. That's always true. That's literally always true. The stock market's like 18 months ahead.
Evidence is there. The economic evidence is inflation is coming down and the economy is holding up pretty well. And yet vast numbers of the public don't believe this.
I think it's going to be an issue for the election in 2024, no question about it. The idea is that while inflation is coming down, inflation rates are still higher than they were pre-pandemic. People still feel that acutely. All the excess savings that we got during the COVID run-up, those have come down. Student loan payments have resumed. SNAP payments, the extra.
Remember, we talked about that yesterday. That Bloomberg had this really fascinating U-turn. If you didn't see that, I made a video on it. But if you didn't see the flip on that yet, the quick little recap on that. Bloomberg yesterday wrote, literally in response to what Sarah just said. By some measures, excess savings remain around $900 billion, and that's excess cash we had from before the pandemic. So in other words, excess savings was zero before, now it's $900 billion. And that may be the reason the savings rate is so low is because people are just spending the extra cash that they're getting. rather than feeling the need to continue to save it. Plus, obviously, homeowners. So, interesting. Okay, I'm going to pull off CNBC here. Let's, I want to see, this is an interesting item here because a lot of us have been focusing on, hey, can small caps rip? And here's a note. With its October low, the Russell 2000 appeared to have fully priced in an economic recession. However, let's see here. With fundamental signs of a modest 2024 recovery on the horizon, the index is looking left discounted versus its own history and the S&P 500. Yet even in the rosiest scenarios, it may be hard-pressed to challenge its former highs, especially if aggregate revenue stays off peak. That's interesting. So let's look at the Russell 2000s for a moment. So we could go to like IWM as an option. That's right here. And there's basically this talk that the Russell, even though it's performed very well since its bottom here in late October, early November, they're arguing we might not be able to get back to these all-time highs if earnings at all of the various different smaller caps that make up the 2000 here are going to essentially not keep up. Because if you don't keep up with earnings, then your valuation here could look more extreme. And so the argument is, will small caps actually catch up? Well, I think a lot of the small caps are struggling with the higher interest rates. They're the ones having to pay the higher interest rates, whereas the big cash-rich companies, they're the ones earning money off the interest. So you almost really have to see interest rates come down first for small caps to really start going. So I wonder if the time to invest in small caps is maybe after another little correction when you get closer to some kind of actual rate cuts, but then meaningful. Like, who cares? You get 25 bips off. Is that really going to make a difference? No. Another item here. Stocks can run but can't hide from a U.S. double dip. A second dip in the U.S. economy is likely underway and could create complications for parts of the S&P 500 that largely avoided the 2022 slump. As vulnerable consumer sectors like discretionary and staples, wow. Are they reading EHAC? Because I'm pretty sure when we go to EHAC, what I wrote yesterday is maybe this is where you want to be, and staples or the discretionary of like clothing are where you don't want to be. Interesting. As 2024 kicks off, but U.S. corporate earnings may be surprisingly resilient as long as inflation keeps easing. That's interesting. That's kind of also what I was mentioning, that the biggest thing is like just keep getting inflation down. And the baseline of the market should continue to be up. I do think there'll be volatility, don't get me wrong. I'm not here to say we won't have another dipply-doodla like we had between July and October. That's always going to happen. But can that baseline trend be up? And I think the answer is it's up as long as inflation trends down. Inflation comes back up, now you got real problems. The market will fall so quickly, you get a miss on an inflation read. Oh no. Why does that happen? Rip. Okay, I was going to listen to Doomburger, but I can't. Whatever. Okay, so we've got about 16 minutes to go until the good old opening bell here. Let's see what else is making news. Not much. Politics and OPEC Plus will set a floor for oil in 2024. Yeah, we'll see about that. Then we've got... Does this work now? Yeah, no. Okay, fine. Okay, what else? Apple. If you haven't heard, Apple had basically there's an injunction on Apple's requirement to pause the shipment on their Apple Watches, which apparently isn't technically an iWatch. I call it an iWatch. They still have it listed as currently unavailable on their website. Apple Watch. Well, I thought they would bring it back right away. They still haven't brought it back right away. I think they ran out of supply. I think they sold out everything they had, and they had the best coupon code they could have asked for. I mean, good for them. Who knows? All right, let's take a look at some crypto. See what's going on in that world. So we've got 42.7 on BTC. Ethereum's almost at 2,400. It's actually pretty impressive. I mean, you're up 6% on the week. Solana. What's wild is you're at a $42.6 billion market cap on Solana. Wow. You also have Kathy Wood with ARK yesterday. Shaved positions off of a bunch of different stocks and threw money into the ProShares Bitcoin strategy ETF. So taking a little bit more of a bet on BTC as we near the hoped ETF approval. I'm so curious to see what's going to happen to crypto after the ETF approval. Like, how much money is in it just to trade it? That'll be the big question. All right, what else here? We have Marathon. A lot of people here were talking about Marathon. So what do we got here? Shares of Marathon and Riot are significantly outperforming Bitcoin this year with gains of 800% on Marathon and 400% on Riot. I mean, yeah, these did go pretty dang low. You know what I'd like to do is visit HUD 8. See, I think that'd be kind of cool to visit one of their mines or do an interview with them at one. I don't know, could be interesting. Surge in stocks comes as digital asset mining companies expand operations to increase Bitcoin production, with expectations that demand for crypto will jump after the ETF. See, that's what I don't know if that's going to be the case. You can have so much ETF trading and trade very, very little in underlying currencies. Although that doesn't matter so much. I suppose. I mean, does it really matter if you have volume? I mean, volume gives you liquidity. Easier to buy and sell if you have volume, but does it really matter if you have a volume drop? I don't know. So, okay, well, interesting. No, not much else, though, on the front of crypto either. Oh, it's like dry spell of news here. It's probably because it's between Christmas and New Year's. You also have very little coming out in the way of market research. Mideast risks and OPEC will buoy oil in 2024. Political conflicts, escalation, rhetoric during the campaign trail. I kind of think the election cycle, I mean, maybe it's stressful, but it's also kind of entertaining. I enjoy listening to debates or covering them. All right, let's do this here quickly. Let's fix this. And let's do a little commentary or Q&A here. Give me some Q&A. Okay. 1 second, though. We're going to do this. There we go. All right. We're going to restart this really quick so I can get the bell back. All right. Let's answer some Q&A here while we do this. Come on. There we go. Okay. There we go. All right. That's restarting. Okay. So let's see here. Thoughts on cannabis stocks. You know, you've had quite a bit of a rally here recently in cannabis stocks as Biden's coming through with what people thought would be more of an immediate move from Biden pretty early on, especially with the latest marijuana moves here. Is it a good idea to buy Enphase today? Oh, I have no idea. You know, I think what you really need is confirmation that you don't have a real estate crash, and then you can hopefully feed some enthusiasm for people to start investing in their homes again, buying solar, buying batteries. You know, Tesla just reduced the price on the Tesla battery packs. The battery packs, I believe, were $8,000, and now they make it a little hard to show how you order it. But I believe they're down at $7,500. So you've got a little bit of a price. Yeah, purchase price. I guess it depends on how many you buy, and that's interesting. Yeah, I mean that makes sense. You kind of get bundle discounts. Okay, so they can range, but there was an email that came out about Powerwalls from Tesla about Powerwalls having a little bit of a price drop. So, what else jetzt heißt? Mortgage rates are currently around 6.625 with no cuts. What are they by June, assuming 1 to 2 cuts? You know, it really, the cuts, and I know this is wild, but the cuts don't matter so much. What matters are treasury yields. Let's see if this works now. What? Let's see. But yeah, it's all in the 10-year treasury. Yeah, okay, cool, that's fixed. All right, great. Now I can hop back on over here. All right. Refresh here and come back. So we'll just watch the 10-year. I mean, I think we're at what? Nah, what we hit today? 10 years at 3.82. It's actually up 3 bips right now. And that's leaving the Dow and the S&P red. All right, let's get back to our good mic. There we go. Audio. Get off AirPods. We don't want those. Okay. There we go. See, look at that. How exciting. We got audio again. Perfect. I don't know. That's so weird that it does that. This is the second time now it's done that. It's just like 40 minutes in. It's like, you know what? I'm done allowing audio from the TV to come through. So, you know, I've really enjoyed TMF lately. So I have exposure to TMF multiple different ways. But that TMF rebound, and this is the week chart, weeklies here. But if you go down to the day chart, you could really see that coming off the bottom there. This is like your Bill Ackman pressure right here. Undoing that, we're just now breaking the 200-day moving average after having broken the 100-day. And there's a belief that we should have no problem getting at least... I was looking at this a little bit. Some folks believe that we could at least get back to a trend that's over here. So this could be a... There you go. A little bit of a technical line that you might consider looking at for a resistance. That puts you at about up another, what, 10, 15% there potentially to go on TMF. And that would bring us down to, what, maybe 3.4 on the 10-year treasury? Would be very interesting. You look at the 30-year mortgage right now. Change that to 740 credit score. What do we got? We are at, yeah, breaking under 7 now for your average mortgage. That's very interesting. All right. A few minutes to the bell. Let's listen in here.
Everyone was talking.
Pippa. What does Pippa say?
Europe. That didn't happen, and prices have since tumbled, including here in the U.S., where nat gas is pacing for its worst year since 2006. Mild temperatures throughout the year cut fuel demand, and output has stayed around record levels, meaning the market is now oversupplied with storage 8% above the 5-year average. Production is so high in part because of associated gas. That's gas produced alongside oil. Crude prices are still above break-even levels, so that's stimulating associated gas production. In total, it's about 15% of domestic supply. But the surge in LNG exports does provide a floor.
Nat gas, bad for everything. You know, the thing, the idea is that utility rates could come down, which then it makes the break-evens different. I think it's so simple. Like, the end-phase trade is so simple. Just look at rates. That's my take. I think it's so simple. Yes, this idea of natural gas prices coming down off of the higher levels that you saw after the Russia-Ukraine a war, as we have stability in that market, as well as in the oil market, is a good thing. But it's also, that's driven partly also by demand, just sort of slowing international demand. Okay, so what's your opinion on Bitcoin stocks? Like, yeah, well, I mean, you look at like a MicroStrategy, it's really just a proxy for Bitcoin. right? I mean, it's kind of like take money from the stock market and buy Bitcoin, and look how much Bitcoin we hold. I mean, it's been brilliant for Michael Saylor. Don't get me wrong. He has become an internet sensation, and the move has been great for the company, which now really just has to be a Bitcoin fund manager. So it's quite fascinating. All right. Are you expecting a pullback in Jan-Feb, first quarter? Yeah, that's the weird thing. It's like eventually, somewhere we're going to have pain again in the stock market, or somewhen, I suppose. And so how do you potentially set yourself up to protect on something like that, right? Oh, look at this. Have you considered the projection in rate cuts is the equivalent of actually cutting due to expectations? Couldn't this fuel a second wave of inflation? Okay. Well, that's separate. Let's answer that in a moment. So, yeah, I mean, going into earnings, I suppose you could look for some low vol stocks and try to buy some puts. Like, let's look at Tesla, for example. Medium volatility. So, I'll see if I can find something low. How is Costco still so high on volatility? Yeah, they're still mega up there. What's low vol? Let's see here. Let's look at a few others. So if I go to obviously, well, the Qs, that's somewhat average. SPY, I don't know where you're going to get discounted volume right now. And something that would actually be sensitive as a hedge play. Everything... the problem is the VIX and everything sort of went up here recently, so it just made your options a little bit more expensive to buy. That's why I'd rather, I'm short Costco, which is tough when the entire market is rising, but I think give me a couple earnings and that'll prove to be right. I don't know, I could be totally wrong, but I'd rather just be short than own options right now because the volatility on some of these stocks has just gone nuts, and I don't want to pay a volatility premium. But as far as this idea about markets pricing in a second wave of inflation. In order to have a second wave of inflation, you have to not only have consumers spend more money, but you also have to have companies not be able to fulfill that demand, right? Because think about it. If you're a company, and let's say you sell Lego coffee mugs, okay? So in 2021, everything's booming, and you sold 200 Lego coffee heads. And in 2019, you were selling 100, okay? So you were selling 100, now you're selling 200. Now you're selling 125, and you're like, damn, yeah, we're up from 2019, but we're definitely not selling the 200 we were in 2021. Well, now, say consumers start going, you know what, we need our Lego coffee mugs. So you get an explosion in people buying Lego coffee mugs. Does the company raise prices because they run out of supply? Or do they go, we could totally support this because we built our supply chains out to support 2021 after the fact. And please, thank you. Now our revenues go up. Now, do you want to be the first one to start raising prices and potentially have people go to, Playmobil coffee mugs because yours became more expensive and then you hurt yourself? I don't think so. So inducing inflation is in a capitalistic economy. It's a lot harder than people think. This idea of as soon as things get better in the economy, inflation will come back. There's no historical evidence of that. There's historical evidence of supply chain crises causing inflation, oil crises causing inflation, expectations causing inflation, which expectations are ridiculously low right now. Whether you look at the University of Michigan, or you look at 5-year break-evens, or you look at 5-year forward break-evens, they're all basically near rock bottom for the year. So I don't know. I'm not. I can't find a way to say that a strong economy induces inflation. I think it's a lie, because here's your break even, by the way. You don't have the historical precedent. Here, look at the break even chart really quickly, and then we're going to get the bell.
Has in the transformative ability for AI and the earnings power of these
I
companies.
find it interesting that Apple and Microsoft, the two you just mentioned, are the worst performing of the top Magnificent Seven. NVIDIA's right there at the top,
220%.
more than 200%. Meta is number 2, up 197%. Tesla, Amazon, Alphabet, Microsoft, and then Apple. But again, they're all huge winners on the year. Here's the opening bells and the CNBC real-time exchange here at the big board. She's the first, a global nonprofit providing equal access to education for women. Over at the NASDAQ, buildgirl.org, empowering young women to pursue careers in architecture, construction, and engineering.
Okay, what is that? 40%-ish green, something like that. That's like 60% red. How are we moving in the open here? Well, we've got the Qs with an initial minute green candlestick there. Marathon Digital. Now, be careful. Marathon's been somewhat memeing a little bit recently. So a lot of momentum there. We've got Tesla trying to push a green candlestick here. NVIDIA, 40 bips. Enphase goes down at the open, 60 bips. Oh, wow. It almost just went green, like right as I said that. What else do we have here? Coinbase, 2 or 3%, but again, nothing compared to the 7% rally you got yesterday. This looks pretty stable. Let's look, anything major. I mean, Marathon, Bitcoin's down about 1.3 in the last 24 here. That's obviously, that's why you get the Coinbase proxy moving down. How has Etsy been? Let's look at Etsy for a moment. Yeah, I think their low was like 60. So we'll take a look at that. So somebody here in the comments says, how did you manage to pass all the tests in 3 weeks? Oh, so talking about the, here it is, Bruce. How did you manage to pass each exam in 3 weeks? It was actually 2 weeks, sir. Because I passed, what was it, 6 tests in about 12 weeks. Yeah. Did real estate help me? No. Like the series 7, 63, 24, 14, 27, these are all a pain in the ass. They are the 24 and 27 especially extremely challenging. But anyway, I wanted to look at Etsy. So let's zoom out over here. And yeah, I mean, it's just the grind, man. You just stay up at night and bang it out when nobody's texting you or bothering you. Yeah, so Etsy's off its lows at 58, but boy, zoom out on Etsy right here. How do you get traders getting enthusiastic about consumers blowing money again when sentiment's still low? You've got the fear that the lower 40%, so to speak, of incomes are just out of money and inflation is crushing them. And that's the warning we got from Nike. So maybe it makes sense. Disney's stuck at $90. First Solar has actually done decently here. Pretty well. This is on the week chart right here. Boy, since the summer of 22, you've more than doubled on First Solar from then to now. Intuit sitting at its 226, right there on its level, 226 resistance. This is a company I'd love to buy if it were cheaper. I just think the valuation is rich right now. Enphase goes green now, up 1%. Although seems to be pretty volatile here. Along with Tesla still sitting at 0.94. Q's dropping a little bit here, 0.22. All right, what do they got over here?
These are quite remarkable. And you also look at the equal weight, also up about 16, 17%. All of this is happening because of the decline in interest rates and the ability of the market to broaden out. The equal weight S&P 500 went from a 52-week low to a 52-week high.
Okay, so Pharaoh Towers here wants to complain, and that's okay. That's okay. We appreciate it. So we don't have a strong economy. Okay, so the claim is we don't have a strong economy. The evidence is commercial real estate is collapsing, housing crisis. Okay, so those almost seem to be like one and the same here, because the only real estate that's having problems at this point are offices. There is no housing crisis. I mean, show me a statistic on the housing crisis. There's no housing crisis right now. New York whining they can't handle less immigration. than they get in Christmas parade. What does that have to do with the economy? So out of all of this, yes, commercial office prices are collapsing. What does that have to do with the broader economy? I don't think that's good evidence. I'm going to give you your like complaint piece of paper back and ask you to update that with a better bear thesis. Yeah, we need a better bear thesis for that. Let's see here. No, I don't hold a position in Disney. Ethereum starting to diverge from Bitcoin. You know, we were touching on that a little bit earlier. I make my own flashcards as I go through. I actually did all of them. Kaplan, STC, Past Perfect. They have different Q banks, and then I put them all in like a little iThoughts. Yeah. So, is there an order of the FINRA tests? No. Let's see here. Last year, this time, last year, this time, you were getting all the tax loss harvesting. You know, you still have some days left here to do some tax loss harvesting. You know, who knows? Maybe that's what we're going to see going into the end of the year here. But then again, maybe people who were going to tax loss harvest did their loss harvesting. And now you actually have, gains. So there's no loss harvesting. I mean, I guess maybe unless you were short, there might be some... Oh, they should have put the face on the other side. There we go. See the smiley face. I have to left-hand it. We believe we put a post out on the podcast coming back next week, just because people are out in the office. They are out of the office. So we were thinking about like, oh, do you do a remote pod or whatever? We're like, no, let's just wait until we're back. And yeah. So once everybody's back in the office, it's kind of peaceful though. Like you go into the office now, everything's just chill. It's like one of my favorite parts of the year to get stuff done is this quiet time. All right, let's keep listening here. And then let me see what the suits are saying too.
Energy. I mean, look what's happened this year, the geopolitical events, and yet oil never appreciated because the supply is so heavy. Consumer staples have some demand issues out there. Yep. We are seeing reductions in inflation around the commodities associated with consumer staples, but there's demand issues. I think there'll be difficulties raising prices in 2024.
Are you going to start a course on passing all the series tests? No. I mean, what I could do is I could just film a lecture in the gold course. If you want, you know, I'll do that. How about this? I'll promise that. Because it's not like course worthy in its own. But if you want all my tips and tricks for like how I study for these tests and pass them, I promise I'm going to write it down right now. I'm going to put it in the gold course. Because we have a lot of things in the gold course, whether it's, you know, stocks or real estate or whatever. Get in before Jan 1, by the way. I haven't really been pitching it much, but we are raising the price Jan 1. Email us at staff@me, Kevin, if you don't have it. But if you already have the gold course, you'll get it for free. How to pass series tests, all of Kevin's tricks. I'll just put all my tricks in there. And I'm not perfect. Like, these things are hard. And I've taken a lot of tests. I mean, NMLS, broker, sales, contractor license, drone test was hard, all of this stuff. But yeah, I'll go through my tips, tricks over there. All right, what do we got here?
Question in Overking when we don't know. I mean, look.
The Qs are just going straight off a cliff over here, by the way. So I want to see if there was any kind of data here that broke. Not really. I mean, the 10-year's up 3.7 bips. It's just trying to have a little bit of a retracement after yesterday's moves. Mid-East risks. I mean, I'm getting nothing here from the suits in terms of commentary. It's so quiet right now. Initial jobless claims, that's all we got. You know, you know how little news there is right now? Literally, one of the headline stories on Bloomberg is, from topless massages to private flights, CEO mishaps of 2023. Bro, come on, man. Like, No, it's not going to go in the AI course, but it will go into the gold course. A video explaining the purpose of each test. Yeah, I mean, they each unlock something you could do, right? Contractor is hard, yeah. Like, I like tests that unlock the ability to do stuff. That's why people are like, oh, Kevin, you should go for your CFA. I'm like, man, there's so much other crap. Why would I go for my CFA? What, so I could promote myself? Like, you get the CFA to gain clout within usually a company to try to get paid more. Well, that's fine. Like if you're an employee, go get the CFA. But what good does it do for me? Nothing. All the series licenses actually let me do stuff. So I like functional licenses. I did the same thing when I had my real estate license. I had my real estate license, and then people are like, oh, you should get all these certifications, like certified short sale agent and certified foreclosure and this and all these certified things. I'm like, why? It doesn't let me, what does it let me do? Oh, it lets you say you passed this certification. I'm like, I don't care. It's a waste of my time. I'm pretty brutal about that. Pass functional tests. Although the stuff you learn to study for the CFA is pretty impressive. Let's see what they got over here.
Just from March, of course, in the bank.
Oh, here we go. Bear thesis. All right, I've been waiting for a bear thesis. Bear thesis. The uncontrolled illegal immigration has led to 8.3 million new people. That is breaking its limits. As these systems break down, crime rises. As crime cities will collapse, disrupting supply. Wow, that is like... That's a pretty weak one there. Like I have to say, I mean, it's a thesis, but man, I mean, what you're really saying is border towns, like El Paso, let's say, the entire city is going to collapse under the weight of illegal immigration, and that is going to create a supply choke point. I don't know, man. That's a creative one. I will say that's a creative one. Okay, so to really understand that, you would have to break down how much supply actually goes through border towns, A, and B, how much of that supply would be disrupted because of illegal immigration. I don't know, man. That's a toughie, man. That's tough. I don't know. I can't say that's a very exciting bear thesis. What's this one? Richmond Fed manufacturing. So manufacturing is in recession. Let's get this though. Richmond Fed manufacturing survey. So 12 hours ago. Let's take a look at it together. All right, read the full report. I love the full reports. Oh wait, they have a little PDF emoji. I gotta get me one of those. Oh, this is like a... Oh man, this reminds me of like 2003 icons. Look at that icon. I don't know, that's like a throwback of an icon right there. All right, so what do we got here? Manufacturing activity. 5th District manufacturing activity slowed in December. We are seeing this. In manufacturing, we're definitely seeing slowness. Firms remain generally pessimistic about the local business index. This is fair. This is a good bear piece. I like this. Thank you. Most firms continue to report declining backlogs as the index remained negative. So one of the problems that you're finding is that companies are pissed that they overstocked to where they're purposely running more lean to try to limit this buildup. Don't they need a reason to cut rates, though? Why would they cut rates 3 times if the economy is working exactly as they want? The Fed cuts as inflation comes down because you don't want to add even more restrictiveness, adding more pain to, for example, manufacturing, leading to potential joblessness. So manufacturing is in the poopers. That is true. And it has been. Okay, price trends. Prices paid, prices received, mostly down, though you have a slight little uptick on the right over here. Wages stabilizing. Backlog, and we have some charts over here on data. But yeah, how long have we been down here on business or on manufacturing? Let's see here. Yeah, look at manufacturing activity though. So here you have an explosion of a positive index read. You have been negative. I'd like to get the actual dates on this. Richmond, maybe I can get it here. Manufacturing composite chart. Let me see if I can get. Yeah, here we go. Okay, so you've been negative on this since April of 22, which is exactly when rates, well, March of 22 is when we had liftoff. It was right about when rates started going up. So you've been negative since then. You briefly went positive in September. That was right here. And now you're kind of just still below this trend over here. I'm not sure that's anything new compared to what we've had over the last, obviously year and a half here. But yeah, it is certainly something to think about. Yeah. Okay, cool. So let's see quickly how El Marquette's moving, and then I'm going to go make another cup of coffee. Yeah, just down, actually. Just down today. Wanting to maybe take a little bit of a breather here. I wonder what's pushing it down, because Nvidia's green, Enphase went negative again. Tesla's green, Zim's green. What's dragging it down? Is it Google? Is it Apple's green? Google's flat. What's Microsoft? No, these are all green. Marathon down about 4. It must just be a lot down a little. McDonald's? How's McDonald's been performing? Oh, wow. Look at them coming out of the hole over there. McDonald's went so low into October. Yeah, McDonald's was almost at... Well, let's go to the week chart would be a little... Nah, McDonald's has been pretty good. Wow, look at that explosion on McDonald's. I have to adjust the chart here. Boy, that's just been straight up, basically. Even its low over here. Its low in October was basically its November of 2021 highs. Wow. That's incredible. Almost $300. Oh, Amazon. Okay. Yep, streaming on X as well. Thanks for being here. Amazon's down 10 bips. Nominal. That's pretty nominal. Okay, what about Palantir? See some folks talking Palantir here. 17 cents, nothing here. Okay, all right. Anything else? Last minute check here. But boy, there's so little right now. FOMO means bond dips are likely to remain shallow. Oh yeah. Yeah, okay, so they're basically arguing that like anytime bonds dip like they are today, because they rallied yesterday, so you're getting a little bit of a natural retracement. Those dips are likely to be shallow because people want to keep buying bonds. That's the thesis, right? Now, thanks for the dividend. Hey, man, look, whatever dividend comes in goes right to investor. That's the way it should work, right? I think if we could pull off what we're trying to do with HouseHack, we'll have distributions as well, but no guarantees. Anyway, all right, I got to get to Course Live. Intel's over 50. What was your passing score? You actually don't get your passing score on basically any tests anymore. But I would guess most of mine were probably like the mid, like 82 to 88 is probably what I think I scored on the tests. Because I have a trick for like when I'm going to go hit submit on the test, I've already added up how many I think I'm going to get wrong. And then I sort of put like an allocation to those, like a weighting. So that way, like I should know if I'm going to pass or not when I hit the submit button. So, am I at all concerned about Congress, you mean Democrats, having a bill to ban institutional ownership of housing? No, not at all. Like, A, nothing's going to happen until the election. B, nothing happens in divided Congress. C, the realtor lobby is the 5th largest in the United States. And not to say that they win all the time, but I mean this is like political posturing. You got to remember that it's politics. How do you get a company to sponsor you to take a FINRA test? You make your own company. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. Look at that move on SoFi, by the way. I mean, SoFi's obviously substantially down from 2021, but over here, It's actually a nice little recovery, over $10 right here. Not bad. All right, folks. I gotta go. I'm gonna go make a cup of coffee, and then we'll be live in the Course Member Live. I'll post the link. All right. Thanks. Bye.